Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:30 a.m. Central Time, and I am recording this in preparation for the market day of May the 4th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened with our Sunday night overnight action. Well, basically scratched to slightly positive in the four broad market indices. The Russell and the NASDAQ are basically scratched at the time of this cut. The S&P and Dow were up a little bit more, about 1/4 to 1/3%. Crude oil up about 0.5%. The euro down about 0.5%. Bonds slightly negative to basically scratch. Gold was probably the biggest mover of the night in the markets that we track, up about 0.2%. In terms of overseas action, China scratch. Hong Kong up nicely, about 1.7%. Japan down about 1.3%. Japan's really fallen hard here in recent days, so if you're trading in any of the Japanese ETFs, you might need to take a closer look at that. Germany scratch, United Kingdom scratch. So, you know what? Doesn't look like data came over from United Kingdom. I believe we may have a bank holiday there. That might be part of what's going on. So we'll take a look down here. Let's take a look at the macroeconomic reports. Let's see. Indeed, in the United States, we really have nothing to speak of today. You got FOMC members speaking. I know there's also some small bond auctions. So you might want to check that if you are a bond trader. And yeah, Great Britain bank holiday, so that may have something to do with these numbers here on the overnight action from the United Kingdom. In terms of tomorrow, we have in the U.S. trade balance and ISM non-manufacturing. So there's a couple reports, one before the market opens and one during the market trading hours. Certainly nothing too rambunctious there. In terms of our current market conditions, short-term volatility again dropped 11.77, and you see implied IV percentiles all again pretty low, all in the lower third of the range. We did have standard deviation moves in 3 of the 4 markets on Friday: the S&P, the NASDAQ, and the Dow, all up more than one standard deviation move. So certainly we've had a little bit more volatility in the last couple trading days than we did perhaps the week prior to that. But again, relatively quiet markets with an occasional burst of energy. But the norm of late has been less than standard deviation moves and nothing particularly exciting. And certainly nothing that really seems to say that we're going somewhere in a big picture. In terms of our daily report, we still are market trend phase 3, higher highs, higher lows in the intermediate term. But there are flies in the ointment along the way. IBD status is uptrend under pressure. GMI index is a 3 out of 6, and active trader market posture is currently turned bearish across all 4 of the broad market indices. So definitely some fly in the ointment. As a result of those opinions, the buy side long portfolio exposure position sizing opinion is only up to 50%, so something to consider there. And you have a hedge warning status of level 1, which is our yellow light. So under yellow light level 1, we don't encourage the initiation of new short-term or intermediate-term bullish trades. So something to consider there. We did have, with the end of the month, we reviewed the portfolio risk opinion, and there were some changes here. It's still calling for call hedges on the upside at 2% out of the money, put side downside at 3% out of the money, and a new ratio here of 3 calls to 4 puts in your hedging activity. So kind of be aware of that. From a volatility base, warnings, really nothing to speak of at this point. Everything is pretty quiet from the volatility standpoint. We do have a number of distribution days, though. If you look at that period, the S&P and the NASDAQ are both at 6, and this is one of the primary causes of concern, and certainly plays into this IBD status with uptrend under pressure, is the number of distribution days that still are present. You also had on Friday new high, new lows. We had 330 new lows, so certainly not a healthy bull market from that aspect. And one of the things that we've been seeing in the reading of late is discussions about breadth. Even as we have set new highs, the breadth in which those new highs have been accomplished, the accompanying volume, has certainly been cautionary statements. We still have that crash warning out there that has shown up on our E-mini charts, though the intermarket risk aversion indicators all flagged risk on with the close on Friday. Option income strategy opinion. The VIX is inside the acceptable window. Just simply consider the potential for increased volatility. Cover call strategies were still bullish overall, but calling for a 1-to-1 distribution between in the money and out of the money strikes. And then on put selling, acceptable for selling puts against a core portfolio basket of stocks that you're willing to own in the position size that you're willing to own. In terms of the portfolio rotation graph, again, while we have some sectors such as semiconductor, the internet index, even the banking index on the regional level that are showing nice strength, and they're certainly in the right quadrant, these are not, tails going in the direction that we like. And in fact, they've all kind of had this rollover kind of approach. So this is not the kind of rotation graph that we like to see to be able to encourage new positions. It really is, frankly, more of a warning to make sure you're protecting profits with your risk management and profit management systems. From a sector market posture, a lot of damage still here. You see, there just isn't a lot of healthy areas. Energy, consumer discretionary, materials, probably the 3 sectors that are holding up the best right now, but the fact of the matter is an awful lot of these lines are flat, and these sectors are crossing back and forth with this ranging action that we've had in current weeks. So not a lot of really healthy places. We did have more bullish action on Friday, and obviously that helped in terms of the one-day gains. But you see, if you look at 1 day, 5 day, 1 month, it's not been an easy road, and certainly, if you had entered, a week ago in information technology, for example, you just scratch. I mean, certainly not a trading edge. Now, if you go back longer periods of time, and 1 month, 3 months, you see a little bit more consistency, but trading action in recent weeks has definitely been very challenging, and not a lot of follow-through. So that is all weighing into our hedge risk level and our various opinions that we've given above. If you are putting together your watch list to initiate new positions, the industry groups that are at the top are retail, internet, healthcare, railroads, and transportation, followed by biotech, per our shadow trader inputs. So that's something to keep in mind. That should take care of us for today. As always, greatly appreciate your investing into us and liking us on YouTube, and then sharing on your trader communities about what you have found here. More information available at falconglobaltraders.com. Disclaimers as always, just hit the pause button if you need more time to review this. And we will look forward to seeing you back here tomorrow morning before the market opens with our market preview. Thank you.